3. Registered pension plans. Percentage of employees with registered pension plans through their jobs. In 1977, the percentage for men was 52%, for women 36%, both 46%. In 2011, the percentage for men is 37%, for women is 40%, and both 38%. Usually, jobs with pension plans are better jobs. Over time, less and less men hold good jobs. Brief history of employer-sponsored retirement plans. In early years, most retirement plans are defined benefit plans. These plans are very generous to employees. In good economic times, companies can afford these plans. Over time, many companies find defined benefit plans too expensive. They switch to defined contribution plans, which are cheaper for companies. Right now, only well-funded entities, such as governments and affiliated institutions, offer defined benefit plans. Employer-sponsored retirement plans. Defined benefit pension plans. Employer-sponsored retirement plan guarantees a specific amount of income when you retire, based on salary and years of employment. Risk on employer. May be contributory or non-contributory. Employer contributions based on actuarial values and assumptions. Actuary reassesses the plan every 3 years. Employer must make at least 50% of the contributions. Defined benefit pension plans. At retirement, an employee will receive a pension benefit based on a specific formula. Defined benefit. Example: Betty is retiring after 30 years of employment with the company. Her employer-sponsored defined benefit pension plan uses the best average earnings calculation to determine her benefit amount. For each year of service, Betty earns an annual pension income of 1.5% of her best average earnings. To calculate Betty's pension income, her best 3 consecutive years of income are taken into account. Betty's best earning years occurred at the end of career. The table below displays her income for the last 5 years of her career, from 2013 to 2017. Betty's best earnings years were 2014 to 2016. Her average earnings for this period were $86,000, calculated from the average of 3 years from 2014 to 2016. Her annual pension income will be 86,000 times 1.5%, that's for 1 year times 30, that's her 30-year service is equal to 39,000. Defined benefit pension plans. It is a vested plan. It is a claim to money reserved for you upon retirement, even if you leave the company. Contributions must vest no later than 2 years after the employee becomes a plan member and must be used to provide retirement income. Vested benefits may be left in your former employer's pension account, transferred to your new employer, or transferred to an individual locked-in retirement account. It is taxable benefit. Employer contributions are deductible business expense. Defined contribution pension plans. It is an employer-sponsored retirement plan where the contribution rate, not the benefit rate, is based on a specific formula. Plan may be contributory or non-contributory. Pension benefits are determined by the return on investment and contributions accumulated over time. The risk is on employee, not on employer. Receiving retirement income from your employer-sponsored retirement plan. Normal retirement age is the age by which employees are entitled to receive 100% of the pension income they are eligible for. In many plans, the normal retirement age is 65. Some plans use a combination of age and years of service. In the event of the employee's premature death, a reduced pension is often paid to a surviving spouse. Now we discuss private pensions. The most important one is Registered Retirement Savings Plans, or RRSPs. RRSP is a private pension that enables us to save for retirement on a tax-deferred basis. Contributions are tax-deductible. Income earned on our investment is not taxed until we withdraw money at retirement. Anyone aged 71 years old or younger with an earned income can contribute. Any withdrawal is subject to income tax. Spousal RRSPs. It is a type of RRSP where one spouse contributes and the other is the beneficiary. Advantages: allows the high-income spouse to receive a tax deduction for contributions. Provide a useful income splitting tool. Tax-free savings account. Buy with after-tax dollars. There's no income requirement. Anyone aged 18 or older is eligible to open a tax-free savings account. Current annual contribution limit is $5,500. Increases once the cumulative annual effect of inflation justify a $500 incremental increase. Unused contributions can be carried forward. TFSAs. Contributions are not tax-deductible. Withdrawals are tax-free and can be recontributed the following year. Can hold account until you die. Can be used for short-term as well as long-term goals. TFSA account types: high interest savings account, term deposit, GICs, mutual fund, self-directed, and group TFSAs. There are many optional retirement plans with tax benefits. It is up to individuals to determine how much one wants to pay. Canadians only contribute about 5% of their eligible RRSP amount. The majority of eligible quotas are unused. People value today's life more than future needs. 5. Locked-in retirement accounts. LIRAs. It is a private pension plan created when an individual transfers vested money from an employer-sponsored pension plan. The main purpose is to provide an opportunity for employees who leave a company pension plan to take the value of their pension plan with them. Can't make regular contributions. Funds can't be withdrawn at will. Must be used to provide retirement income. Retirement income conversion options for RRSPs. By the end of the year in which you turn age 71, you must cash in your RRSP or transfer into an income-producing plan. RRSPs are fully taxable when you cash in, so it is common to transfer all RRSP assets into a RRIF to defer tax. You do not have to sell assets when transferring. Percentage of assets held in RRIF must be taken into income each year by a prescribed factor. This table shows the RRIF prescribed factors. Say you are 65, you have to withdraw 4% of the value of the fund. And when you are 90 years old, you have to withdraw about 12% of the value of the fund. RRIF withdrawal example. Vicky turned 71 in 2017. Before the end of the year, she must either collect her RRSP for its cash value or transfer her RRSP assets into an income-producing plan. Vicky decided to transfer her RRSP to an RRIF on November 15, 2017. As a result of her transfer, Vicky must make a withdrawal from her RRIF before December 31st, 2018. The amount that must be withdrawn from an RRIF is prescribed by the CIA in an RRIF table. Exhibit shows an RRIF table highlighting the minimum amount that must be withdrawn. Assuming that Vicky is 71 on January 1st, 2017, she will have to withdraw 5.28% of her RRIF assets during 2018. The amount that she has to withdraw will be based on the value of her RRIF assets on January 1st. The RRIF table represents only minimum withdrawal amounts. Vicky has the option to cash in her RRIF at any time. There are other RRSP conversion options, such as annuities. There are different kinds of annuities. Term annuity is a financial contract that provides a fixed sum of money at regular intervals until a specified year. Life annuity is a financial contract that provides a fixed sum of money at regular intervals for one's lifetime. Registered annuities are annuities that are created using assets from an RRSP with no risk that your investment decreases in value. Annuity example: Vicky could have used her RRSP assets to purchase an annuity. For example, if she expected to need income that would be produced by her RRSP until age 91, she could use her RRSP to purchase a 20-year registered term annuity. Of course, there is always the concern that Vicky may live past age 91. To avoid the risk that her annuity income will stop at age 91, she could use her RSP to purchase a registered life annuity, which would guarantee her an income for life. On the other hand, what happens if Vicky dies the year after purchasing the life annuity? In this case, Vicky will lose most of her investment since the RRSP assets were used to purchase the annuity. To reduce this risk, Vicky could purchase a registered term certain annuity for 20 years. This type of annuity will guarantee an income payable to Vicky or her estate for 20 years. Your retirement planning decisions. Choose a retirement plan, determine how much to contribute, allocate your contributions. Which retirement plan should you pursue? If your employer offers a plan, consider it first. Your employer will make at least 50% of the contributions. If no employer-sponsored plan, consider investing in an individual retirement savings plan, such as an RSP or TFSA. Retirement planning example: Eric is planning for retirement 30 years from now. He plans to contribute $400 a month. Suppose the return from his investment is 10%, 5%, or 3% per annum, compounded monthly. What will be the total wealth at retirement for each level of return? Solution: with monthly compounding, the number of total compounding for 30 years is 12 times 30 equal to 360. Compounding at 10%, total wealth at retirement is 400, which is the monthly payment, times 1 plus 10% divided by 12, that is monthly compounding rate, with the power of 360, that's the total time of compounding, minus 1 divided by 10% divided by 12, that's the monthly rate, which is equal to $904,000. That's a lot of money, right? Almost $1 million. But if compounding at 5%, it is $332,000. So about 1/3 of the 10%. So the rate of return is halved, but the final result is only about 1/3. Compounding at 3%, the final wealth is about $200,000. So it's much, much less. Note, with the same level of contribution, final outcome can be very different depending on the level of returns. There is little control on the level of return we can expect. An example on compounding and future value. Suppose you invest $5,000. If the rate of return is 10%, 5%, or 3%, what will be the final wealth level after 40 years? Solution: compounding at 10%, 5,000 times 1 plus 10% to the power of 40, we get 226,000. It's almost $250,000. That is a lot. Compounding at 5%, we get 35,000. It's only about 1/10 of compounding at 10%. And compounding at 3%, we get 16,000. It's much, much less. How much should you contribute? Determine your potential savings from contributing to your retirement plan. How much can you contribute per year? What is the return you will earn on your investment? How many years until your retirement? How much retirement income will you need to live comfortably? Consider your existing assets and liabilities. Will you be supporting anyone? What are your personal needs? How many years will you live while retired? How much one should save for retirement? Given the difficulty of estimating how much income you will need at retirement, a safe approach is to recognize that OAS and CPP will not provide sufficient funds, and to invest as much as you can on a consistent basis in your retirement plan. After maintaining enough funds for liquidity purposes, you should invest as much as possible in retirement accounts, especially when the contribution is matched by your employer. A common rule of thumb is to save at least 10% of your after-tax earnings in a combination of retirement accounts. Some personal reflections. Many years ago, some young faculty members were talking with a senior colleague approaching retirement. One person asked the senior colleague how much he saves for retirement. He said he doesn't save a single cent. This attitude is quite representative among Canadians with good pensions. Most large institutions provide company-sponsored pension plans. Total contribution, including employer's contribution, is about 10% of your income. An average Canadian worker makes about $50,000 a year. His company pension contribution is about $5,000 a year. Together with CPP and OAS contribution, you already pay about $15,000 for retirement every year. For most people, it is much more valuable to spend money when one is young than one is old. We can have one more memorable vacation, one more precious child, and one more beautiful memory when we are old. Why squeeze our youth to pursue a mirage of paradise in old age? Median age of some countries: Japan 46, Canada 42, USA 38, Mexico 28. From the median age data, we can understand why Germany and Japan are declining, why USA is more energetic than Japan, why Mexicans are moving to USA. How about Canada? Simple data contains a lot of information. A final word on sustainability. If fertility rate is below 2, a society is unsustainable. So, what is the proper level of retirement funding? Retirement funding, as well as other fixed cost expenditures, should be reduced to levels so that the fertility rate will be higher than 2.